You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie, and as always, I'm here with Miro. Today, we are looking at the grandfather of healthcare, Johnson & Johnson, reporting their fourth quarter of 2025. It is January 21st, 2026. And just a quick reminder before we start, we're just two friends chatting about the markets. This is definitely not financial advice, just our personal opinions. So, J&J, usually let's say the comfortable sweater of earnings reports. Predictable, steady. But Miro, looking at this release, it felt a little more dramatic than usual.
Yeah, dramatic is one word for it. Expensive is another. Look, the headline numbers are solid enough. Revenue came in at $24.6 billion. That's up about 2.5% from last quarter and over 9% year over year. Earnings per share hit $2.10, little down from the $2.12 we saw in Q3, but basically stable. But the real story isn't what they earned, it's what they promised.
You mean the big 100?
Exactly. They finally put it in writing. Guidance for 2026 revenue is between $100 and $101 billion. First healthcare company ever to clear that bar.
That is massive. I mean, psychologically, crossing $100 billion in revenue, that puts them in a very exclusive club. It feels like a victory lap.
Maybe. Or it's just inflation and acquisitions wearing a trench coat. But no, look, credit where it's due. They are scaling. But the market reaction was interesting. Did you catch the pre-market action?
Oh, I did. It was all over the place. I saw it drop down near 209 before my coffee even finished brewing. I thought, uh-oh, did they miss? But then the call starts and boom, it reverses. Close the day up 2.5% at 216.30. What was that about? Usually J&J trades like a bond.
Yeah, it was a sentiment flush. I think early morning traders saw the net income, which was flat to slightly down at $5.12 billion, and panicked about the costs. Because there are costs, specifically litigation. They took a $900 million hit this quarter related to shareholder resolutions. When you see a number that starts with a 9 and ends in $100 million in the expense column, algos tend to sell first and ask questions later.
Right, the ghosts of courtroom past. But then management gets on the mic, reminds everyone about the $100 billion, and suddenly everything is forgiven.
Pretty much. Plus, the segment highlights were decent. MedTech was the standout for me. Sales surged to $8.8 billion, up 4.4% from last quarter. Now, sure, Q4 is always strong for surgeries, people trying to use up their insurance deductibles before the year ends, but this was also driven by acquisitions. They've got Shockwave fully in the mix now.
See, that's the narrative hook for me. You've got this massive ship, J&J, and they're basically swapping out the engine while it's moving, spinning off orthopaedics in 2027, buying up high-tech heart stuff like Shockwave. It feels like they're trying to trade steady for sexy, or at least as sexy as medical devices get.
Careful, Susie. You start calling catheters sexy and we'll lose our PG rating.
Hey, high growth margins are very attractive.
Fair enough. But look, even with MedTech doing well, there's a shadow hanging over 2026. Tariffs. They explicitly quantified a $500 million hit for next year just on tariffs. That's $500 million of profit, just poof, gone to trade policy.
Ouch. And yet the stock held up. So investors are basically saying, we don't care about the tariff bill. We like the growth story.
For now. Or they just like the dividend and the safety. But there's something underneath those MedTech numbers that I think we need to scratch at. Because when a company this big says, we're growing, you have to check if they're actually selling more products or just buying more revenue.
The classic organic versus inorganic debate. All right, let's peel that onion, because if they're buying growth, that $100 billion party might have a pretty steep cover charge.
Yeah, let's get into the details.
Right. So, sticking with that growth number for a second, you know how they're guiding for roughly 6.7% growth at the midpoint next year?
Yeah, the path to $100 billion.
Well, here's the thing. A chunk of that isn't selling more knees or hips. It's just time.
The 2026 fiscal year has a 53rd week in it.
Wait, they invented a week?
Basically, it's an accounting quirk that happens every few years, but management admitted it adds about 100 basis points. That's a full 1% to their operational sales growth. So when you strip that out, the organic engine is, well, it's still running, but it's not purring quite as loudly as the headline suggests.
That is classic. We had a record year because we had more days in the year.
It works if you don't read the footnotes. But look, the real structural change isn't the calendar. It's what they're doing with the portfolio. Because if you look at MedTech, they are making a massive bet that I don't think people fully appreciate yet.
You mean the orthopedic spinoff?
Exactly. They confirmed the separation is on track for mid-2027. Think about that. Orthopaedics, fixing broken bones, joint replacements, that is the bread and butter of J&J. It's boring, it's steady cash flow, and they are actively trying to get rid of it.
Because it's slow growth?
Right. They want to trade steady for high tech. They explicitly said they want their asset mix to be over 70% in high growth markets after the spin. And the poster child for that is this new robot, Ottava.
The soft tissue robot. I saw that in the release. They finally submitted it to the FDA.
They did. But here's the detail that caught my eye. They submitted it via the de novo pathway.
Okay, I'm going to need you to translate de novo for us non-regulatory nerds.
So usually when you launch a device, you use the 510K path. You tell the FDA, hey, this is basically just like that other machine you already approved, but ours is blue. It's fast, it's easier. De novo means they are telling the FDA there is no predicate device. This is unique. Nothing like this exists.
Whistle. That sounds risky.
It's high risk, high reward. It means the scrutiny bar is way higher. They aren't just iterating on Intuitive Surgical's designs. They're trying to claim a whole new category. If it works, they have a moat. If the FDA gets sticky, that launch timeline drags out. And they're burning cash while fighting those tariff headwinds we talked about.
So they're basically burning the boats on the beach, getting rid of the ortho business to go all in on unproven robotics and, what was the heart stuff? Pulse field ablation?
PFA, yeah, which is incredible tech using electric fields to treat arrhythmia instead of burning or freezing tissue. They're launching catheters like Varipulse there. That's where the growth is. But again, it's competitive.
It feels like a totally different company than the J&J I grew up with. It's less Band-Aids and baby powder and more Silicon Valley with scrubs.
That's the goal. But the problem with acting like a tech company is you inherit tech company volatility. And speaking of volatility, we have to talk about the legal side. Because while they're building robots, they're still fighting ghosts in the courtroom.
The talc cases? I thought they were settling.
That was the hope. But the tone on this call shifted hard. The CFO basically said they are moving to aggressively fight in the tort system. They're appealing the special master ruling. The strategy has gone from, let's write a check and end this, to, we'll see you in court for the next 10 years.
Which explains the $900 million in costs this quarter. That's not a settlement fund, that's a war chest.
Exactly. So you have a company that's trying to sprint towards the future with robotics, but it's got this massive legal anchor dragging in the dirt behind it.
That is a vivid image. A robot pulling a lawsuit.
Welcome to modern healthcare.
Oh, so yeah, let's step back for a second and think about what all this means going forward. Because if they pull this transformation off, it's brilliant. But if they stumble, that 100 billion number might be the peak, not the floor.
Right. So where does this leave them heading into next quarter?
Honestly, it leaves them in the middle of a massive trust exercise. They're asking investors to look past the messy legal bills and the tariff headaches and focus entirely on this shiny, high-tech future. It's like they're saying, ignore the leak in the basement, look at the new skylight.
And it's an expensive skylight. But you're right. The next few quarters are going to be a friction test. We know the headwinds. They explicitly flagged that $500 million tariff hit for 2026. That is $500 million of margin pressure that they have to offset with efficiency. That's not a rounding error, even for J&J.
And on the far side, you've got the Stelara cliff. Management keeps saying the patent expiration is in the rearview mirror, which sounds confident, but objects in the mirror are closer than they appear, right?
Especially when they're following the Humira curve. The CFO admitted they expect erosion to accelerate significantly this year. So the math creates a very tight squeeze. They need the new drugs, Darzalex, Tremfya, and the MedTech volume to grow fast enough to cover the hole Stelara's leaving and pay the tariff bill.
So basically they have to run a perfect race just to stay in place?
To stay in place? No, to hit that double-digit growth promise they made for the end of the decade. If they execute, they become a $100 billion growth machine. If they trip, they're just a very large, very expensive conglomerate with an identity crisis.
Well, no pressure then, but I guess if anyone has the balance sheet to weather a transition year, it's them. They're still generating nearly $20 billion in free cash flow. That buys a lot of patience.
It does, but patience pays a dividend. It doesn't drive a stock price. For 2026, I'm watching the margins. If they can actually eat those tariff costs and keep margins flat, then I'll believe the efficiency story.
A show-me story of the ages. All right, that feels like a good place to put a pin in it. We've got robots, lawsuits, and a $100 billion target. Just another quiet quarter in healthcare.
Quiet as a heart attack.
Exactly. And that's a wrap for this one. Let's head to the close. So, before we sign off, I want to take a moment to peel back the curtain a little bit. What you're listening to right now, Earnings Unscripted, is actually a bit of an experiment. We are a project created by a small team of enthusiastic humans who are exploring the frontier of AI and how it can be used to really enrich us. In fact, this entire episode was built by a team of AI agents working together, from the research analyst digging through the 10 Qs, to the scriptwriter drafting our dialogue, to a fact-checking QA specialist. And finally, well, us, your hosts. We're all collaborating to deliver high-quality, up-to-date information in a way that would hardly be possible otherwise. We'd love to know what you think. If you have questions, comments, or just want to see how the sausage is made, reach out to us at earningsunscripted@datamadness.ca or follow us on X. Thanks for letting us explore this with you.
See you after the next call.